Good morning, everyone. Welcome to Your Money Matters. I am your host, Angela Giroux, and joining me as always, Ted Bauman and Clint Lee. The three of us are together again. Now, before we get underway today, as always, I like to give you a good reminder that if you're interested in finding out more about the Bauman letter where Ted gives specific stock recommendations, you can click the link above or below. And we do invite you to do so. It's completely risk-free. And now might be a good time to join, given everything that is going on in the markets. We're all looking for opportunities out there, and it's a little bit tougher than it was last year, to put it mildly. Some of those tech stocks, the small caps that seemed like sure bets, certainly are not this year. And then, but where do we turn? The markets don't seem to have any sort of direction. Everybody was excited about the recovery trade. That hasn't panned out exactly as we thought it would. Washington's still on the fence, making lots of decisions. Feels a little bit like pin the tail of the donkey, and I'm wearing a blindfold and they're spinning me up and I don't know which way I'm facing. So today, we're going to try to make sense of it. We're going to try and see what investors can do in situations like this where there doesn't seem to be any sort of direction, and if there are any sure bets out there. So Clint, let's take a look at what's going on here.
Yeah, as you said, last year was it felt so easy, right? And now you're several months into this year, and it feels incredibly hard. It's just because of all the volatility that we've had going on underneath the hood. And we've talked about the sector rotation and everything there in the past. But, I think what that's pointing to is that we're in the very early innings of a very important regime change, sort of at the macro level, where you're starting to transition from being in more of a deflationary environment to more of an inflationary environment, at least as it pertains to commodity prices and other types of natural resources. And so I just want to show one chart on here because this has very important implications for how different asset classes perform. So here's a chart. This goes all the way back to the late 1800s, actually. And this is a ratio. This has the S&P 500 as a numerator and then a producer price index for commodities as a denominator. So when the line is rising, that means the S&P 500 is outperforming that PPI commodity index. And what you'll notice is that when we have these periods of sort of this deflationary environment, that's the blue shaded areas on this chart, you see that line rising. You see stocks doing better than commodities, and then vice versa. When you start to hit an inflationary environment, that's the light red or pinkish area on here, you see that line falling. That means those commodities are doing better. And so on the right-hand side, you can see we've been in sort of this deflationary environment for the last 10 years or so now. But we've seen falling commodity prices largely throughout that time frame. But there's much reason to believe that we're going now to this inflationary environment, and this could be an absolutely terrific spot to pick up commodity prices. So just to show a more extreme example of that, I've got another chart that is another ratio chart. So this has a commodity index now in the numerator, but the NASDAQ 100. So we know it's heavy in tech and growth stocks in the denominator. So now, when this line is rising, that means commodities are doing well. When it's falling, that means the NASDAQ is outperforming. And what I wanted to highlight on here is this goes back to the mid-90s, but you see on the left-hand side of the chart where I have the first circle on here, that is the end of the last tech bubble. That's the end of the tech bubble back in 1999, 2000. And you can see where that ratio was. And now look at what's happening just recently. Look, that ratio is actually dipped below the prior tech bubble. That goes to show how much growth in tech stocks have been outperforming commodity prices, really over the last decade or so. But with where this ratio is, if we're now starting to get to this inflationary environment, this is a great spot to start looking at commodities. And if you want the evidence that we're starting to make that transition to that environment, just pick up a copy of the Wall Street Journal or any other financial newspaper, and you're going to see headlines about shortages of lumber or shortages of semiconductors. It's spreading to the technology space as well. And all that has to do with just the surge in economic activity that we're seeing. So last chart for me on here is a gauge of economic activity. These two lines on here are the manufacturing ISM, the blue line, and the services ISM is the red line. And all this is really telling you is what activity is like in those two sectors of the economy. The dashed line on here at 50, when these indexes are above 50, that means things are expanding. And you can see right now on the right-hand side of this chart, we are well above the 50 line. In fact, that manufacturing ISM, the blue line, this is the highest it's been in 38 years. And so we're starting to see all the stimulus lead and reopenings lead to all this economic activity. And so that's why we're making this transition to more of an inflationary environment.
All right, now, Ted, I'm going to turn to you because I'd like to drill it down a little bit more. Clint mentioned commodities, but let's talk more specifically, which commodities?
Right. Well, first of all, what's a commodity? A commodity is something that everybody uses on a global scale to do, whether it's eating or making things or whatever it is. It's something that everybody needs. And when the economy is on an upswing, people demand more of them. The thing about commodities, though, is that sometimes it takes a while to gear up to meet expected demand, future demand. And so that investment cycle usually lags behind. So in the initial stages of a commodity boom, prices often rise quite fast because they're running up against supply constraints that were established in the previous kind of slack period. That's what we're seeing. So I want to show the first chart is one that reflects back on my Friday video, which is where I spoke about platinum group metals. But this is a chart that shows the cash price of platinum divided by an index of the S&P 500. So essentially, if the the line is rising, that means that the platinum is outperforming the stock market, basically. And as we saw, Clint mentioned earlier, just after the dot-com crash, the platinum price rose, and it rose relative to the stock market. Then it collapsed. In the midst of that, the great financial crisis, it kind of got back to where it probably wanted to be in terms of normal economic activity. But then it suffered a long-term decline. Again, this is relative to the stock market. But look at the bottom right-hand corner there. It's ticking back up again. And that's a pretty convincing uptick. That's not a kind of a false uptick like we saw in 2016. So that means that certainly that commodity, which is essential particularly to the automotive sector, but also to many industries, is definitely ticking up relative to the stock market. Okay, here's a couple more. Here is, this is soybeans. Soybeans obviously being the main food stock for much agriculture and all kinds of things. I've drawn a green horizontal line, which is kind of the average over the long term for where soybeans want to be relative to the level of the stock market. Look how low it is. I mean, it's as low as it's ever been. So that means that relative to the stock market, soybeans have a long way to run. They can go up a lot, and they have been up a lot. Back in the 70s, they were much higher in value relative to the stock market, and that's where we could be going again. Next chart is wheat. A very similar situation. Wheat has been dawdling along for a long time, but again, it's well below its long-term relationship to stock prices, and has lots of room to run up. Last chart is essentially copper, which is probably the most important bellwether of any kind of commodity metal, because it's known as the great predictor. If the copper price rises, that tells you where the economy is going. Again, we saw a big dip in the late 90s relative to the stock market. Again, this is divided by an index of the S&P. So relative to the stock market, copper crashed, but then it rose again towards, during that secular housing boom that we had during the 2000s. And then it's really had a long, long slide, but look again on the bottom right-hand corner, it's ticking up again. So again, all of this stuff tells us that these commodities are all at historical lows relative to the level of the stock market. And that's an important consideration, because if you have a dollar and you're trying to think where you want to put it, right now, investing in commodity futures or investing in ETFs that trade in commodities is probably a better bet than most of the kinds of investments people have been making in the last year or so, even over the last decade. And to the extent that we do see big stimulus and infrastructure spending here in the United States, that's just going to get stronger because people will bid up those prices in anticipation. So if you get in on the train now, you'll do well.
Right now, I know in the May issue of the Bauman letter, which we're actually sending to members today, we're filming this being Monday, You talk a lot more about this supply demand and platinum group metals specifically, and you give a great way to play it that actually magnifies the gains of these commodities. So again, a reminder to join if you haven't already. But let's talk, for the sake of this video, let's talk some ETFs that might be a good idea.
Well, I got a couple, but basically one is DBB, which is the Invesco DB Base Metals Fund. So it's exposure to things like copper and also PGMs and other kinds of things, but basically industrial metals, the kind of silver as well. And that's a good one to get into. The other one is DBC, which is the Invesco DB Commodity Index Tracking Fund, which is a broad basket of commodities, including agricultural and whatnot. And, again, I mean, this is the basic strategy at the beginning of a commodity cycle. Put some of your money in there, not all of it, but it's going to do relatively better than probably most of the stocks that we've been holding. And there'll be some stocks that outperform, but in general, if you can park off part of your portfolio in something that's going to outperform the market and start now, you're going to come out ahead. The last thing is that if you have, usually it's a minimum of $5,000, but there's something called a commodity trading advisor, and you can basically buy into their strategies. They do a mixture of long and short trades in commodities, and over periods of time, like the one that we're in now, they tend to outperform the market quite substantially. Depending on the strategy and the trader, what these guys do is, they spot where things are going, and you put your $5,000 in there. It's kind of like a hedge fund or managed fund or whatever. But basically, that's another opportunity if you have that much to invest.
All right. Well, thank you both very much. I hope this was helpful for our viewers. And again, please join us at the Bauman Letter for more specific ways to play this boom. We will see you next week. Thank you so much.